We are with Kevin Green today again. Thanks for the feedback, everybody. I know everybody was excited about Kevin coming on. He added a bunch of value to the channel recently coming on. The video is called, let me bring that up as I literally brought it up and took it right back down because I was trying to bring up something for you guys. Let me pull that up again. Is Navigating the Commodity Market Waves with Kevin Green. So definitely check that video out to learn a little bit more about Kevin. So we're going to talk about what Kevin and I use as traders. The question keeps coming up. What do you guys use? How do you guys trade? How do you guys figure out what markets you want to be in and stuff like that? So we can start with just showing you guys some of the tools. Kevin's an analyst and he really knows a lot about the markets. He obviously has a lot of data that he can always spit out at any moment. So people like that, we all get our information from somewhere. So we need to figure out where we get our information from, and then you guys can see if that pertains to your own trading. How you doing today, Kevin?
Doing pretty good, Jason. How about yourself?
Good, man. It's great to have you on again. Yeah,
Appreciate
it
you.
was really exciting to have you on last time, man. It's a lot of fun to talk commodities with somebody. I mean, for in general, it's a it's a field where everybody's interested, but not many people can really talk the talk. So it's really cool that it was cool to have you on, just talk through that stuff. Not to mention heating oil, energy, gasoline is still continued since our conversation. So far so good. Let's see where that ends up. It could be a very interesting trade. If you guys didn't see that, we were talking about the oil markets and the possibility of it moving higher. We were talking about there wasn't much downside risk, but there certainly was upside risk at the moment. So right now we're going to kind of go through some stuff of what Kevin looks at in the market. So Kevin, when you're looking at the market and you're just starting out your day, we all kind of have something where that's our go-to. What's your first go-to for the day as a trader?
Oh, so the first go-to is obviously going to be an economic calendar. So I think that's going to be the number one thing that everybody's going to be focusing on, not because of the data so much. Maybe you like that data. I do. I like to get into the nitty-gritty, but you also want to know the certain times that certain economic data is coming out because it could impact the market either to the upside or downside, and it could also create a lot of volatility. So, there's different websites that are out there. There's Forex Factory. That's a decent one. I've actually been utilizing Bloomberg Economic Calendar. Reason being is that it's actually a little bit more, a lot quicker when it comes to the economic data that comes through. And then it not only has what's going on in the United States, but around the world, and captures some of the economic data that maybe may not be on Forex Factory, even though Forex Factory is a really good resource. And I do like some of the basic charting that it does have when it comes to the economic data. But I usually go first to the Bloomberg economic data, and I can actually kind of share my screen if you want. I can kind of talk through
Yeah,
my
love that.
process here. So let me share my screen. 8,000 of them up, of course. All right. All right. So you should be able to see my screen that has the Bloomberg on it. So, if you have a Bloomberg subscription or if you have that access, by all means utilize that. That's pretty expensive. So I'd say, utilize this particular calendar. There's other ones that are out there, but once again, what I like, they have the indication of what time it's coming out. It's going to be pretty much an Eastern time unless you set it yourself. Tells you what country is there, and it tells you what the number is and the estimate. And that's what I really kind of focus on here, especially when you're looking at like today. Today's a pretty good day to be able to get some economic data. We're on a Thursday. Every Thursday, we have continuing claims, we have initial claims, and today we actually had some other economic data like the Empire State Manufacturing Index, which the last one came in pretty low, actually like recessionary low. So the market was really kind of focusing on that to see if we would have a little bit of a rebound. And if that first number was a little bit of a blip, we did see a little bit of a recovery there. So I like utilizing this. You can kind of scroll down, see what's happening for the day. It also captures for you futures traders out there. It also has like the API data. So the American Petroleum Institute. So they report their oil inventory numbers on Tuesday, and then the EIA data is coming out on Wednesday. So what I like is I'll even just scroll up. I know it's probably going to be hard to see here, but that API data is actually proprietary. So sometimes it's really hard to scour the internet to be able to find out what that number is. Now it'll tell you the high level number. So you can see API weekly crude oil stock. And we can see that it's a build. So this is the first site that I go to, kind of write it down, or I kind of just highlight in my notes when these are coming out, what the expectation are, and then once again, kind of blocking out maybe certain areas of the day where we might see some volatility move to the upside. Also, treasury auctions can do that as well. So that's the first thing that I'm going to do. I have some other things that I do focus on. I'm not going to be able to provide them here so much. I'll try to do so after I try to go off my screen. But I like to read the Hightower report. So because I have access to our platform here at Schwab, we have a service from the Hightower report that provides a daily update on each of the futures markets. So from metals to grains to equities to interest rates, every single one, they have a nice little recap email that comes out on a daily basis, not an email, it's a PDF that comes out on a daily basis, usually around 8 o'clock Eastern time. So I go through that report. Usually it's about 2 pages, 3 pages, kind of just give a high level overview of what's going on in those markets. And it also talks about what happens overseas or overnight, which I think is good. Some of the other tools that I use that does not cost any money. One is that commitment of traders report. Now we had this and talked about this in the last video, and it's kind of critical in my system as far as trying to analyze the marketplace. Now this report comes out every week. It comes out on a Friday, and it reflects everything that happens all the way up until Tuesday. So if you're looking at the report, it's not going to include the activity that happened on Wednesday, Thursday, and Friday. But once again, it gives you a really decent gauge as to where positioning is in the market. So I like to go to the CME group for this one. There's other tools that are out there. I think barchart.com has another great interactive commitment of traders report. I like the CME one just because you're able to just kind of click on the different baskets, and we talked about these baskets before, right? The producers are those that are either extracting oil, or they have some form of a reason to be able to hedge their position within this marketplace. They're not really speculating one way or another. You have your swap dealers that you can click on. That's going to be those individuals that may have a producer that comes to them and says, hey, I need to hedge risk. That swap dealer will take that cash instrument and then go out and hedge risk in the futures market, trying to become delta neutral as much as they possibly can, and then they make a little bit money off of the swap. We also have then managed money. This is the one I really kind of focus on. This is the traders that are managing CTAs, managing ETFs, what have you, right? So they might have some form of exposure when it comes to the crude oil markets. Generally, and this is not going to be all the time, but generally, once managed money gets active and they start going long or they start going short, and it's getting to a point where their net position is getting to a 52-week low or 52-week high, right? That's kind of when you may expect a little bit of a reversal in the marketplace. I like to follow producers. A lot of people don't, but the producers are going to show you the pure dynamics that's happening in the marketplace. If they continue to drill, if they continue to extract oil, they're going to have oil in their inventory. They're going to want to be able to hedge that particular risk. If we have a geopolitical event that's out there, you might see producers starting to go long, right? And why would they go long if they're already long the physical commodity, right? They already have this inventory. Well, sometimes if you have geopolitical risk, like we saw with the Russia-Ukraine conflict, they might not be able to deliver because of logistical issues, or just the demand is spiked so much. So they might have to go long in order to hedge themselves because price continues to move up. That's another good dynamic. So I actually really do focus on the producers because it gives you that direction of where the market's going. And usually when there's a significant amount of selling from the producers, and you have market makers taking the other side of that flow, that provides you that foundational base for some price action. I won't go too much deep into that. I think you and I are probably going to have another conversation just about the commitment of traders in general. We have other reportables. So these are individuals that are trading large contract sizes, but they're not like in these other 3 buckets that we already talked about. And then we have non-reportables, which don't really have that much flow, but those are usually like retail traders, but they carry a lot of size. But once again, they don't meet the threshold of an institutional trader or a producer or anything like that. So you can see on the bottom of the screen here too, it'll tell you like the preview, it'll give you like what the actual long, short, what the net position is. how the contract change, which is good, percentage of open interest. You can kind of go back and kind of test this out. And I'll use like a live example here, and I'll show you some other tools. So I don't have a thing to be able to draw on this. So we can kind of look, you can kind of eyeball it, or you can actually just look at the net positioning. But like we can see here, like producers, for instance, last week, they increased their long position and their short position, but net, it was for the most part increasing those long positions. And we kind of talk about this is just every week. But if you notice, Jason, let's say since January 16th, right? And we go and look at a chart of crude, and we continue to see this net positioning starting to increase for producers. What's happening to price? What happened to price, right? Price went up. Now, why would producers go long? Yeah, this is why would producers go long? What did we have in January? That Arctic blast. That Arctic blast took over 900,000 million barrels per day just in North America alone. That was from the IEA report today. Just in North Dakota alone, it impacted 650,000 barrels per day. And then we had some Gulf refineries that took off around 15% of their operating capacity because of that Arctic blast. Well, if I have an Arctic blast and I'm not able to deliver, or I might have some issues with logistics and prices go up, I can't deliver the physical, I have to hedge myself. That's why we see that kind of net position moving to the upside. So very basic example of how you can kind of identify, boom, like, okay, they're starting to go long. They look at forecast 14 days out, right? Just like people that trade natural gas, they know exactly what's happening. They're going to position themselves, and they rightfully did. They positioned themselves before that event, which is another reason why we saw that fundamental move to the upside. So I want to kick it back over to you. I don't want to hog this. All right, my bad. You know me. You know
Oh
me.
no,
If
dude,
we could
this is
talk about
great.
it, I'll drill into it. But this is
No, this
actually a
is
really good
great because this is
example.
it's the reason where you were on the first place. I wanted to have all those conversations about exactly this. Like, let's talk about COT reports because there's so many people who ask so many questions about how to read that, and that was perfect because to me, I'm also like you. Like I know like a lot of people will be like, I just watch the hedge funds, and if they're short, I'm short, and what, or if they're short, I'm long, and vice versa. But
Yeah.
really the producers are the ones that have the data. If I'm in my own business and I understand most things about my own businesses, then I know how I should be positioned, and that's the people that you really want to know. That's the people with the data and the inside information before you're going to get it. Not saying that they're inside trading. They just know if there's a bunch of people buying. For example, if you're looking producers at gold, they know how mining is going. They know
Mm-hmm.
the inside of that market. They know how demand is going. They know how supply looks. So following those people are where you're really going to find an edge. This is the main reason why you see them very, very long at bottoms and very, very short at tops. Like they have that edge. We don't. So I completely agree. I think that was a perfect way of putting that, just so we can kind of show people how to use these tools, because it's a thing about it. Like, yeah, I could show people the COT reports, so can you, but how do they use the tools? And like this is exactly how to use it. So once again, this is incredibly important. It's not the way, for me, it's not the way I get in or out of trades,
Yeah.
but it's the thing that gets me interested first. So if I see, like Kevin's pointing to, okay, the producers are buying, like Kevin was pointing to earlier,
Yeah.
okay,
Yeah.
then I'm interested in that. Like now I'm gonna be interested in oil, and you guys who follow the Substack see like I put out things all the time that, hey, I really like, for example, corn right now looks
Yeah.
insanely good if you just look at the COT reports. It's going to move up at some point. I do not know when, but it's going to move up at some point. So
Yeah.
as I see that signal, then I go to the price action. I wait for that to actually give me a signal to buy. So when I put all that together, now I have a great strategy that can continue to make money, buy things a little bit more lower than like you would have to in another scenario. For example, if you're a trend follower and you're doing like you really want to do longer term as a trend follower, 100, 200-day highs even. But if you can add the COT data in there, you can basically get in a little bit lower, 50, 60, 70-day highs.
Yeah.
So I really like the way where this is going so far. So the COT report, perfect. Don't
Yeah.
feel free to take as much time as you want.
Yeah, and actually this is just another good example, right? So now we're on managed money, right? And I'm not saying automatic, like you said, not saying automatically fake, because managed money can take prices even higher, right? So in September of last year, or let's say July to August of last year. So there was a base formation. I mean, producers were basically screaming in the COT report, hey, this thing's about to spike. Now, and it did, right? And we saw that move to the upside. It got to about $90. And at $90, I was like, hey, be very careful here. Be very careful because producers started to unwind. And it just seemed like managed money was starting to just start to get in. And I'm not even kidding you. It was one trading session, spiked up to what, $95, 95 and some change, and backed up. And it never saw that price ever since September. And that was the first week or that second week where managed money was just going hard in the paint. And everybody that was on every financial network was like, I love energy here. It's going to go higher. It's going to go to 120. It's going to go to 150. You know, super cycle comes out every once in a while. You know, you love when you hear that super cycle name. And super cycles will happen. We kind of talked about the last time. It will happen. You just need the right ingredients. It's not just supply and demand dynamics. It's geopolitical. It's logistic. It's a whole bunch of different stuff. But here's just another good example, right? So we had managed money. So you look at the blue line. So blue line is showing longs. Uh, Orange line is showing shorts, and then green line is just those that are spreading positions. I don't even look at that. So I just look at who's going long, who's going short, what's net. And we kind of see this very interesting thing that happened where now they caught themselves and they're trying to catch up. But you can kind of see they start to go down and they're starting to kind of like increase their long positioning, if you will. And as soon as they're doing that, and this yellow thing's the net price, as soon as they're increasing the long positioning, what happens next? Right. And I can go back to the producer and show the same type of situation. I have futures price on here. Futures are starting to pick up, right? They started shorting their positioning, but then they started kind of increasing that net again, and then we start seeing that reaction. And then you can actually see it right here, right? So they're kind of already building that long position. They're building up longs in January on January 9th. They're building longs in net long on January 16th. What's happening? And then as soon as they start fading that move, that's when you see the opposite where managed money is just starting to ramp up. So I usually kind of look at that. Now it's not going to hit all the time. Sometimes you can have them in tandem. The Russia-Ukraine conflict is a perfect example of that. I mean, it was just so much so that just producers were like almost 1.1 to 1.2 to their short position, which is usually not what happens, right? You usually want to be, for the most part, net neutral or a little bit more net short if you're a producer because you have physical inventory. So that's that report. And actually, before we move forward here, because we are nerding out on this, let's check out
I love it
corn.
because honestly, dude, this is the question I get more than anything else because I use the COT reports so much and I'm always pointing to stuff on them. This can really be something that can help a lot of traders. So I'm totally down with this. This is great.
So, and it's nice with this tool too. So there's two different ways that you can do it, and I'll kick it back over to you. So I only look at futures only positions. Some people actually combine futures and options. That's going to be your flavor because the problem that I really don't like when you add options is that you get a lot more speculators in that really don't have any skin in the game, in a
Yes.
sense, right? For a producer, if I'm looking at producer long position and they're going long futures, they have skin in the game. They have to do something. They can utilize options, but as you know, options have theta decay. Some options in certain markets are not as liquid. Some of them are only cash settled, depending on which one you use. Some of them you can't even exercise until a certain. There's so
Especially
many
the
different.
futures markets. Yeah.
Yeah. So they're going to go, but sometimes you can look at that futures and options. What's going on there? I usually don't. What about you? Do you like looking at both futures and options net,
No, I
or you
never
go
do
just,
either.
yeah,
I
okay.
never look at the options because it's exactly like you said. I love I sometimes once in a while if I'm really bored, I'll look at the options. but
Yeah.
it's also like the positioning of options will just tell me like what people that are crazy speculators are doing. And not to mention like the thing of working in the fund industry, you see people sometimes are like almost scratching itches with options. Like
Yeah.
they're like, oh well, I'm a producer. I'm kind of bored today. You know,
Yeah.
like I've seen it happen with farmers actually. Like it's my
Mhm.
first thing I ever did in finance was working with farmers, and so farmers do that stuff all the time, and they're like, yeah, I think it's gonna go up or down. It'll be completely the opposite of any of their fundamental analysis that they're doing. But yeah, so I completely agree.
Yeah, so I moved this over to the commitment of traders for corn. Okay. Now you can adjust what the yellow lines are, and I have been doing that. So I know people that probably following this video are like, what? But you can change the range as far as the length of time. You can change to see that yellow line for net position, gross position as a percentage of total OI, which is open interest. You can do futures price. I kind of just toggle back and forth. I would love to be able to overlay both at the same time. I can do that on certain other platforms. I'm a hobby programmer, so I'll nerd out. But this is showing like where corn is right now for the commitment of traders, and you can kind of see what the flow is. And this is over since February 2019, but you can see what the net short position or the net position is for corn at this point in time. And we are seeing a little bit of a shift, right? Like if we go back and I change this from the net position and go to futures price, this is why I love doing this so much. What happens? This is the futures price now. Yellow line's going up. What's happening with the short interest for producers? Also going up. Short positioning going up. Producers are going to show you the way. If they have to short more, that means demand's for the most part there. We can kind of continue to see that. And as their short positioning gets lower and lower, futures price is going lower and lower. And right now, we are seeing actually longs for producers kicking up a little bit more, and which is why we see this dynamic with the price going down. But this is different than technical analysis for equities, right? Where the trend is your friend type of thing.
Mhm.
For commodities, you want to try to buy dips and you want to try to sell rips, because commodities, for the most part, don't stay at elevated levels for too long, in certain respects. Now we have weird stuff, sugar. You have what cocoa, or right now, right, where that's like literally a supply issue when it comes to what's happening over in West Africa and the drought conditions, as well as storms that are hitting those plants and stuff like that. Stuff like that can happen, but this is just kind of what we're seeing with corn right now. And for producers, for the most part, they're starting to ramp up their net position for a little bit, but it looks like they're starting to kind of flip it when it comes to their long positions here. So you can kind of make a case. Maybe we are seeing a potential bottom, and there's a lot of fundamental factors with corn as well, right? Like what's happening over in Argentina, what's going to happen with the Brazilian crop as well. Do we see the flip from La Nina to El Nino, which we're in right now, back to La Nina? And then some people are actually predicting that could actually happen by the end of April. And if that is the case, that would traditionally be most likely devastating when it comes to crop production for South America, which could push prices up. So yeah, this is it, man. This is it.
No,
What are your thoughts on this?
no, I like it. I mean, the only thing I would add is that if you are looking at the commodities, like they do trend, but it's not something just to add on to what he said so people aren't too confused.
So,
Just if you are trend following, yes, you can run a trend following system, but you can't just buy commodities, hold them for the next 30 years and think they're going to make money.
right. Yes.
That's kind of what we were getting
That's what
at
I
with
meant.
that one.
Yeah.
Because there are
Yeah.
trend systems make a ton of money in commodities. The problem is that if people just buy it and they're just buying into oil, let's say, and they're hoping, it's going to go up forever because it's been going up for a little while, it's just not going to work like the S&P 500 or something. Not to
Yeah.
mention something that's also important to understand about, because somebody who said that to me on a space the other day, they were like, well, commodities go up and down and blah, blah, blah. And it's like, well, basically the S&P 500 goes up all the time, and the reason really is because it's market cap weighted, so the
Mhm.
best stocks end up being the leaders. For example, like Exxon was a leader many years ago. Procter and Gamble, all of
Mhm.
these things were leaders in the stock market many years ago, And now if you go forward to today, you'll see that, it's a completely different market. We're seeing that tech, which had a huge boom and bust cycle in 2000, is now the extreme leader in the market. So markets go through rotations. And lots of stocks also, like I forget what the number is, but you might even know this, but a certain amount of stocks actually go, like more stocks go down than up in the S&P 500 as well. So there's tons of things that go through boom and bust cycles. It doesn't mean that you can't make money trading it. So I really like the idea of, like, as a trader, commodities are great vehicles.
Yeah.
As a investor, commodities are terrible vehicles.
Yeah. So yeah, let me clarify my statement. Once mainstream starts talking about the commodity, and if that's then when you are interested, that's what I mean by, okay, that don't buy, sell rips, buy dips. You are right. The difference also too with equities when it comes to commodities like soybeans or crude oil or natural gas for that matter, even though we're seeing a collapse, commodities have a finite amount of supply. In certain respects, either there is crop growing seasons, maybe the infrastructure is not there when you're talking about crude, and we have sometimes we have gluts, right? When it comes to commodities as well, which could fuel selling to the downside. Theoretically, equity markets don't have a finite amount of supply when it comes to capital. It just takes time to generate capital to have it flow into an equity market. All else being equal. That's why we've seen the market go up continuously since 1930, even though we've had boom bust cycles throughout that. It's the accumulation and the multiplying of dollars. Let me go to some of these other things here real quick. The CME also has something called the CVOL tool. So CVOL is kind of like their equivalent, loose equivalent to the volatility index or the VIX for equity markets. When you're looking at the VIX, that's the volatility metric for the S&P 500. That's they use 30-day constant maturity type of model, and they basically wait out the SPX calls and the SPX puts that are out of the money, blah blah blah. CVOL kind of does the same thing. The composition of the calculation is different. You can check out the methodology. They got that here, actually, literally on the page. But they have something called CVOL, and they have this in pretty much every single commodity market. And so what I also do is I actually go in and I have all of them on right now. So we're looking at the ag market, and hopefully that's enough for you guys to be able to see. But you can kind of like click on and click off certain markets. So I'm going to click off pretty much all of them. And it has its own agricultural index for volatility. So now it's sitting at pretty low levels. I kind of look at that and say, hey, vol is trending down, but we're also kind of in that seasonal period, if you will. So if I actually kind of move this out, let's see if they have to like 20, let's go to 2020. We can kind of see there's seasonal trends when it comes to volatility. May, when you start the planting season, you kind of go through June when you start to get out of your inventory, and then so on and so forth. You can see these little blips. So I kind of check this out because if we go, let's say, back to corn, and I'll go back to a 1-year chart, or we'll do a 2-year chart. We're going on a 2-year chart of corn. Vol is pretty low, right? And once again, this is not providing advice, but usually if you're an options trader, you sell volatility when vol is high, you buy volatility when vol is low. So it's kind of another, a feather in the cap, if you will. If you are somebody that wants to go long corn and you're looking at opportunities, you can go long the contracts, you can go long the options. Options would actually still be fairly cheap because you have low volatility. And so this is just kind of another chart that I look at, CVOL for, and you can kind of do comps as well. So we can see for this one, we see actually natural gas volatility is going up right now, even though price is coming down. And that's because there's a lot of people that are interested in this now. Be careful with that too. Now a lot of people are talking about how short natural gas positions are doing, and natural gas is trading at historic lows, only about 10-15 cents away from historic lows. Now everybody and their mother wants to get into natural gas. There's a lot of inventory that's out there, yes. Do we have an issue with Freeport and the LNG facility? Yes. Do we have this temporary pause for expansion for LNG exports? Yes. Be careful. Be very careful.
Yeah,
because
I
everybody's starting to
agree.
layer in.
I agree. I mean, I was talking about this the other day, which is the optionsellers.com guy. Do you remember him?
Yep.
Yeah, so I mean that basically the moral of the story is he's basically selling calls on natural gas because natural gas was in a downtrend basically from forever till 2018. And so basically you can make a ton of money selling calls on it. And so he's selling naked calls on natural gas. He's selling naked puts on oil, and then both of them
Mhm.
reverse. Basically, we
Yeah.
go into the little we had a huge drawdown at the end of 2018. I think the market went down about 20%, but oil went down a ton. I think it hit $80 all the way to 40 or something crazy. Got cut in
Mhm.
half basically. And then natural gas like spiked out of nowhere because so many people were shorting it. So you like Kevin said, be very careful of doing things like that with natural
Yeah.
gas. It is a wild product. I think the thing about it that people just don't understand is that like you have to always size for volatility. If the volatility of the product is absolutely insane, like if you measure it like Kevin has up here, if you measure just natural gas and can you go back to oil for a second? So natural gas
Yeah.
75.
I'll put
Yeah. So the energy sector 50, like you're
oh, so
basically.
yeah, I'll put oil is gonna be in orange, natural gas in green.
Yeah, so if you look at it, like the general levels of both of these are completely different.
Mm.
And even oil is a volatile product. So natural gas is a much more volatile product than oil. So you just have to understand, like, okay, my volatility is really high. So my positions have to be even smaller. Like
Yep.
if you have $100,000 account, to make it an even number, that's easy. Think about that your stop on natural gas has to at least be, if you're a long-term trend follower, if you're trying to catch like a move that's like from, a couple dollars all the way to $10 like it did a couple years ago, you're going to have like a 25-30% trailing stop. I mean, that's
Yeah.
insane. Like, so like understand that your position has to be really small and sized accordingly to do something like that. Whereas something like a bond, the volatility is going to be completely different and much lower. So, like Kevin said, like it's a scary one to continue to short,
Mhm.
and it's also a scary one to buy as well.
Yeah, and we actually are seeing a little bit of a divergence, right? So like price
Mhm.
continues to go down, but you have volatility going up. We had a conversation offline about this, right?
Yeah.
But anytime you see vol going up, price is going down, or something really trying to like disconnect, unless that vol skew is just heavily weighted on the put side, just be once again be mindful of that. Any type of weather disruption or any type of weather report can reverse natural gas fairly quickly. And we saw that
Yes.
earlier this year where that spread was just like absolutely ginormous for that Arctic blast situation. Everybody, you can see the writing on the wall where it was going to go. We knew where it was going to go, but you can't get in. You can't even get in front of that downside move because volatility is up so high, and natural gas can move from $3 to 5 to 8, and you can get slammed. So I got this one, and then I'll show my last one here.
Yeah, we'll go to the liquidity tool. We'll just end
Yeah,
on the CME tools, and then we could do maybe another one on some of the other things we were talking about.
cool. Yeah. So this is a liquidity tool for the CME, and I'm not sponsored by the CME by any means. I know a lot of people over there, and I can tell you their education department is top notch, and they literally
Very much
love to
so.
hear. Yeah, they love to hear the feedback. And um, what's actually very interesting, that CVol tool is something that I knew a couple of individuals on the education staff that were helping out with that. And they take a lot of great feedback too. A year ago, I was talking to one of those guys and said, hey, there's a lot of people that want to trade natural gas, but they can't. Now they have a micro contract. So they're very open to hearing feedback, and they have a lot of educational tools that don't cost any money. So the liquidity tool can show you three different things. Here's what I use it for. I use it for book depth, but you can use it and actually do a bunch of comparisons. So book depth is going to show you how many contracts are sitting on the bid, how many contracts are sitting on the ask. The more contracts that you have on the bid and ask, the more liquidity you have in the marketplace, the more it takes to actually move price. You want to have a very liquid market. When we have liquidity coming off and the size on the bid and ask is getting lower and lower, that's when you can have these violent moves in the marketplace to the upside or downside, and it doesn't take much to move price. So they have a really good tool that updates on a daily basis that actually can show you what the depth of market is for any particular product that's out there. It's on E-mini S&P futures right now, but you can trade it to 2-year notes. We can look at beans. We can look at all that stuff. We'll leave it on the S&P 500. You can also compare it to something. So I always compare it to the bid-ask spread. The more liquidity that you have, theoretically, the spread should be lower, right? Smaller spreads, more liquidity, wider spreads, less liquidity traditionally. So I always like to see what the bid-ask spread is. And so if you click on view chart, you can kind of look and it'll show you, it has a really good representation on what the bid-ask spread was for that day. You can kind of see the quantity. So we're looking at, we could actually look at yesterday. And Jason, I brought this up the other day, right? And we're seeing it in real time. We saw a lot of volatility over the last 2 days. And I said, keep your eye out on this chart because we could see the bid-ask spread or we could see liquidity drying up. And we are. If we're looking at, sorry, guys, this is kind of a, there you go. If you're looking at February, let's look at February 12th. You can even go before that. February 12th, the quantity on the B, and that's what's showing up on that thing, was 75.8. You can look at the basically the ask 75.1. So what does that mean? 75 contracts on average on the bid, 75 contracts on average on the ask. Cool. Do we see any type of skew there? No. Is that a fair amount of liquidity? You can kind of see. But if we kind of go towards, let's say, yesterday, Valentine's Day. Now, remember, the previous one was 75 on the bid, 75 on the ask, right? Yesterday, even though it was green day, we did see some chop in the market. Bid, average size, 55. Average size on the ask, 57. Small skew on the ask, right? Selling pressure was hitting a lot of those bids yesterday until the last hour of the day. Liquidity came down. That's over 20 contract move. And you might say, hey, Kev, that's not that much. 20 contract on notational was a lot of money, to say the least. So this is kind of a nice tool. And then once again, you can kind of go out and customize it. You can see what it did for a week. You can see what it did for a month. You look at the daily time frame as well. And then what else do we have on here? This blue line. Remember, we have the bid-ask spread. We're comparing it. That blue line, that purple line is showing the bid-ask spread. What also happened as liquidity came down? Spread on that also went up. So there's an inverse relationship. That's when you can kind of tell, hey, there might be some volatility in the marketplace. If I can see on February 1st, I'm going to just throw it out there. We probably had some intraday volatility in the marketplace. And you can kind of go out and you can actually look at, and then I'll kick it back over to you here in a second, but you can kind of go back and look at 2023 and say, hey, like, let me see what happened for the last year and let's see what happens with volatility. You can change it to whatever time frame. And you can kind of see these little squeezes that occurred. Last year, October, what happened in October? In August, we started seeing liquidity going down. October, look at that. September, October, boom, liquidity's just dried up. We had a small pullback in the marketplace. We bounced back up. We start seeing liquidity come back out. We're not saying it's going to be the end all be all, right? But it's a tool that you can use in your toolkit to say, where am I at in this marketplace right now? How can I use these? CME's got some really great tools. Jason, what do you think?
Yeah, no, I think in general, like you have to have some way of measuring liquidity. However you trade, however you do this, like you have to have a way of measuring liquidity. There's plenty of ways. This is one that's a really good one and very objective and easy to look at. For me, I look at the macro, so I'm able to look at the macro and kind of understand, but also that fits my time frame. This, for you shorter term traders, this might help you guys even more. So being able to look at all of these different tools is kind of why we brought this to you guys today, just so you guys can get a feel of like what we're doing when we're actually having conversations with you guys. We're not just talking, out of our rears and basically trying to be like, hey, this is exactly what's happening in the markets. We're looking, we're diagnosing, we're taking the tools that gives us our edge. Because really, in the end of the day, it's all about having an edge in this. And our edge comes from our tools most of the time. You just have to figure out what type of trader you're going to be, how you're going to put that together, and then what you look at every single day. What's the first thing you go to kind of get data? And it has to be past hey, I pull up my app from investing.com or something, or I go on Robinhood, like it has to be past that, because if you're
Mhm.
just doing those things, you're doing what everybody else is doing.
Yeah.
So, get past that. There's plenty of tools. Like we'll keep doing this. Maybe we could start a little series on stuff like this, and bring you guys more tools and more books and more educational resources so you guys can move forward in your trading. So, all right, Kevin, we'll wrap it up right there. I think this is perfect.
Hey, I always appreciate you, Jason. And by all means, I'm looking forward to doing this even more here and bringing more tools to the forefront. And what's also nice too is trying to bring tools that don't cost any money, or trying to find a way to gather data that doesn't cost any money, or maybe has a very low outlay, right? Because
Yeah.
sometimes you can buy tool packages from certain people, right? And you can spend $100 a month, and maybe it's just not the one that's working for you. So once you kind of get your trading strategy, you can find the tools that are out there to be able to complement that. So I appreciate you having me on, man. And it's always a pleasure. Always enjoy doing these type of conversations here.
Yeah, man. It's always fun to have you on. Be on soon, I'm sure, and we'll talk soon, man.
For sure. See ya.